네, 버나드 케인과 함께하는 진짜 미국 주식 시간입니다. 오늘은 종목에 대한 이야기보다는 시황적인 이야기를 좀 다뤄보겠습니다. 아무래도 연준의 매파적인 기조가 글로벌 증시 전체를 뒤흔들고 있기 때문에 이에 대한 투자 전략, 대비 방법이 굉장히 중요하겠는데요. 일단 연준에서는 이 3월 금리 인상을 거의 확실시하는 발언을 했고 또 연말에는 대차대조표 축소까지 언급을 하면서 이 시장이 계속 투자 심리가 위축되고 있습니다. 이런 금리 인상 전망에 대해서 한번 짚어주시죠.
Well, what we've seen over the course of the last 6 months is the Fed adopting a stance that is more reflective of the fact that they want to raise interest rates because they believe that this transitory inflation that they initially thought they were going to have back in the first and second quarters of last year is now a little more sticky. Whether they have the right approach or not, or they believe it is not, time will tell when we find out down the road, is it sticky or is it more transitory? I believe it's more transitory, and we will explain that later. But when we think about what the Fed's actions do, we have to think about that from the perspective of inflation. The Fed has two main goals. The first is maintain full employment, and the second is to maintain stable prices. Accelerating inflation is not necessarily stable prices. So what I've done right here is I've taken a look at the inflation-adjusted S&P and compared that to the rate of change of the consumer price index. The rate of change of the consumer price index is our best gauge for inflation. So I don't care what the inflation rate is today. On this chart, I compare where it was today versus where it was a year ago. So if the inflation rate today is 6.5%, which is we're a little bit above that right now, and the inflation rate a year ago was 1.5%, our rate of change over the course of the last year is 5%. So what I've done is I've drawn a 5% line that goes across this rate of change of the consumer price index over a 12-month period. Now, this goes back to 1947, and we can see that there are times that the market has gone above this 5% level, okay? And sometimes it's been a predictor or a forecaster of lower stock prices, and sometimes it's not been. So we have to watch and see how this goes. Now, the question becomes is where do we think this is going to go down the road? Is it going to continue higher here or start to roll back down? I believe it's going to start to roll back down, and we will talk about that a little bit later. Let's go to the next slide. So the last slide was an inflation-adjusted S&P. This is just straight S&P right here on the top clip, and the bottom clip is still, it's just a little bit cut off. It's blown up a little bit in terms of the time frame, but this is our same level right here where, in other words, we're not doing a rate of change. We're taking actually the price index and comparing it. And we can see that when the price index turns down, these are all these vertical lines right here. Okay, when the price index turns down, that's a positive for the stock market. So the fact that we can get a higher level of inflation and then inflation starts to go down, that's a positive for the stock market. And so what we want to see right here is we want to see a condition where either the price index goes higher or the price index starts to go down. If the price index starts to go down, we're going to go back into these occurrences that we've had here, which has been actual buy opportunities. Let's go to the next slide. So now the question becomes, what is the problem with inflation and how does it affect the markets? It's not the inflation rate that affects the markets. It's if the bond yields go up faster than the inflation rate, that's a negative. So what we've done right down here on this chart, this is the inflation-adjusted S&P again, and down at the bottom, this is the inflation rate divided by bond yields, corporate bond yields, average corporate bond yields, not highest quality, not lowest quality, but average corporate bond yields. And so the average corporate bond yield is the denominator. If the average corporate bond yield goes higher faster, that's going to send this below this measure right here, okay, this threshold line. And so what we found is that periods of time where the bond yields go up faster than inflation, that's been a negative, and it's all in pink. That's been a negative for the stock market. But you can see right here, we're still pretty far above that line. And there's no indication necessarily here that we're going to go back below that line. We can drift lower and go higher. That's not a problem. It's going below that line where the bond yields are going up faster than the inflation rate. Let's go to the next slide. So when we think about the inflation rate and all that and bond yields, what we really want to think about is, are we in a recession or are we not in a recession? So going back to 1947 again, our pink circles are occurrences of where we've been in recessions. The blue circles are where we've slowed growth down, but we didn't go into a recession. So let's say we grow at 3.5% or 4%, okay, and then we slide that growth rate down to about 0.75%. We never go negative, and then we start to go back up again. Those have been actual good buy opportunities as opposed to when we're in a recession and we really have to slow down. So what are we going to go through right now? We don't even know that we're going to have negative growth or a slowdown in growth. Currently, right now, we're forecasting earnings to grow at 8% for 2022. So we don't necessarily have any indication that we're going to go into either a recession or a growth slowdown. Let's go to the next slide. Now, this is where we're going to start to say, is inflation transitory or is it sticky? And this is why I believe it's going to be transitory. Our inflation rate came because supply and demand went out of balance. And the reason supply and demand went out of balance is not necessarily that demand slowed down or picked up, but that the supply was constrained because we were in COVID. We didn't have people working. We couldn't get semiconductor chips. We had problems across the board in a variety of instances. We couldn't fully staff meatpacking plants, so the price of beef went higher. Now, let's just think about this from the perspective of two things, okay? The first is a 2-year change in 10-year note yields. So where is 10-year notes versus where they were 2 years ago? We still are at really low levels of 10-year note yields. And where is the pink line right here is the prices paid component of the purchasing manager survey. That's where the purchasing managers around the United States basically come and present a composite prices paid number at the beginning of every month. And so we look at that. That's a great forecaster, and we'll show that in a minute. That's a great forecaster of where consumer prices are going to go. Well, right now, what we've seen is yields are going down, okay, compared to the last 2 years. Well, that has tended to lead the prices paid. So I anticipate prices paid to continue to go lower as long as these yields continue to go lower. And this is over a comparison to where we were 2 years ago. Knowing the data, this is not going to go higher in the near term. Let's go to the next chart. So we took that same prices paid, basically our pink line, okay, and we're going to now compare it to the CPI index, okay, and we're going to lag it 6 months. We're going to move out the prices paid ahead of the consumer price index by 6 months. So we can say, where do we think that the consumer price index is going to be in 6 months? Well, we're pushing this out. And so I believe we're going to start to go lower in the consumer price index over the course of the next 6 months. Now, let's go to the next chart. I'm sorry it's a little blurry, but this is actually the prices paid component of the Purchasing Manager Survey, and we can see since early 2021 or mid-2021 till now how that prices paid component has been going lower. Let's go to the next chart. Okay, so in this case right here, what we found is that the consumer spending on goods, last year people bought things, they redid their houses, they purchased things. So we found that we had strong demand for goods, not services. When we look at services, like restaurants and all that, they were shut down. So our service component slowed down, but the demand for the goods was stronger. We need to get those things back online to trend. Let's go to the next chart. We had imports hit a peak last November, and what I think, adjusted for inflation, what we found is that we have so much product, like at the ports, like the Long Beach, LA port, the Jacksonville port. We've got so much goods and services at the ports that as we offload those from those ports that are still backlogged a little bit, that's going to continue to reflect in growth. And when they sell those goods from those ports, we're not going to see it with substantially higher inflation, because now the product is actually into the system as opposed to the demand for the product without having the product in the system. Let's go to the next chart. So Cornerstone Economics, it's an economic consulting firm in the United States. They did a forecast, and what we see is year-to-year changes. Right now we're at 6.6% year-to-year change for headline CPI. First quarter they anticipate to be 6.1, but by the fourth quarter of next year they anticipate it to be 1.4. All the product inflation has been in the goods, less food and energy, and that's going to be negative in a year from now. The services inflation rate has been reasonably constant. So when we go back and we think about that very first chart that we looked at, and we get to 5% and we start to go back down, this is why I believe we're still going to start to go back down.
네, 어려운 차트이지만 그래도 이 인플레이션 기조와 정책에 대한 이 긴축 기조가 미국 현지 상황에서는 어떻게 받아들여지는지를 알 수가 있었습니다. 이제 S&P 500 지수 같은 경우는 전문가들은 올해 말에 4,700포인트까지 상승할 수 있다고 내다봤는데 어제 종가 기준으로는 4,300선 부근에서 거래 마쳤습니다. 1월부터 3월까지 1분기에는 증시가 어떻게 흘러갈까요?
Okay, so how does this impact the view of where we should be in the first quarter? Well, I'm really thinking about 6 to 9 months out, because what the Fed is doing is they're all concerned, and our media, our financial news media, is focusing on the hot button issues. Why we have inflation today, how big is it, what that's going to be. Well, what we really want to think about, because the stock market is forward-looking. The stock market is thinking about where we're going to be out 6 to 9 months. So as we start to crystallize the view that I think we're going to have, that we're going to have very little inflation in 6 to 9 months, I believe that that stock market is going to start to reflect that. What we've seen currently is a transfer from growth stocks that we had in 2019, 20, and 21 and into more value stocks. Well, value stocks is a much more defensive game to play. And as people are selling stocks because they're worried about, they listen to the newspapers, they listen to the television, and they say, oh boy, we're going to have inflation, we should start to sell our stocks. Once that stops, I think we're going to start to go better. We're still looking at 8% earnings growth for 2022. And if we have 8% earnings growth and we have very little inflation in 6 to 9 months, the stock market should be substantially higher. Will we be higher than here by the end of the first quarter? I think so. But I think our better opportunities for price appreciation in the stock market is probably going to be in the second, third, and fourth quarters.